This is the current federal tax developments for the week of June the 16th, 2025. Current federal tax developments are brought to you by or State Society of CPAs. Dollars, and what we're going to talk about this week will be the developments that have taken place over the past week. We even had a Supreme Court decision during the week on tax. So, a number of interesting things took place. We'll first talk about the fact that the IRS has issued the updated list of automatic accounting method changes. This time, Revenue Procedure 2025-23 is where you'll be looking if you have a client that is looking to change an accounting method for which an automatic procedure exists. You're going to find it in there along with the updated, potentially, instructions on how to take care of that. And speaking of accounting method changes, we actually have a court case for Conmac Investments that relates to a question of whether a particular issue this taxpayer faced was a change of accounting method or not. We'll discuss kind of the reasons why that's important, and also the year in which one must take into effect any 481A adjustment if you have a change in accounting method. We have yet another conservation easement case in the case of Glade Creek Partners, LLC. We're also going to talk about tax treaty exemptions and this issue about what is going to be considered to be an amount that is paid to somebody as a stipend or other payment in a postdoctoral program. What of that is considered to be potentially excludable from income, and what is considered to be, nope, not excludable. We'll also talk about an issue that's an interesting one about the problems that can happen to you if you're not clear on all the ways you are attempting to claim a refund on a claim for refund you file, especially when you then try to take the IRS's denial to the courts. In this case, with the case of Shleifer, turns out that the taxpayer did not list a second theory under which they could have claimed this deduction, and because of that, they were just essentially stuck. They had no choice but to just not have their refund claim denied. It didn't really matter. The court didn't have to look at whether or not there was a valid, potentially valid claim here. They just said, tough luck. It didn't really raise it correctly. We are going to talk about the U.S. Supreme Court's decision in Commissioner versus Zuch. We had talked about that earlier when the oral arguments were heard by the court, which wasn't all that long ago. And now we're going to talk about their final decision. For those who've forgotten, that was the case from the Third Circuit that looked at the question of if you have a collection due process case that is proceeding in the tax court and the IRS seizes your tax refunds for later years and effectively wipes out the debt for which a levy was being proposed, is that just end of the tax court case? The Third Circuit had said no. We'll see what the U.S. Supreme Court said. And we'll also talk about some relief given to digital asset brokers in Notice 2025-33 that relates to the reporting you're going to see for this year. And we'll talk a little bit about that, also to remind you of the fact we are going to see the new 1099 DA comes out this year. So we are going to be seeing that on 25 returns. So with that, let's go ahead now and talk about Revenue Procedure 2025-23. The IRS's updated list of automatic accounting method changes. This particular change, we're going to look at this list of automatic changes. The IRS issues this revenue procedure every so often. What they do is they just update it. The idea is prior to when they started doing this, which was back in 2015, as I recall, the IRS used to have a whole bunch of different places you had to go look to find your automatic accounting methods. The ones that you could do. Each procedure stood on its own. They decided to make it into one very large consolidated notice, which would then, during the interim period, after it was issued, there would be new notices issued, right, to add to that list. But then every few years, the IRS would go back, make any changes that might be needed to items that are already in the revenue procedure, which, in this case, certain things are no longer relevant because the years they would cover are basically now gone, and also incorporate those brand new ones that might have been issued since the last time they did this. Now, remember, the idea of the automatic method change is you have to have the commissioner's permission to change your accounting method. Now, you do so by filing Form 3115. And if it's not an automatic change item, you generally have to file your 3115 early in the year, and you have to await an IRS ruling. And you file your 3115 early in the year because you can't actually prepare a return using the new method until the IRS has approved the new method. And that, by the way, is true even if your old method doesn't follow the law. Doesn't matter in that place, right? But there are a number of methods because that's obviously a pain, and certain things, the IRS has decided it'd be worthwhile to just, quickly streamline this. And so what they have are these automatic methods. So instead of filing your 3115 early, you actually file the 3115 for automatic methods, a copy with your return, and a copy is sent to some IRS office. Over the years, it has changed a couple of times. You always check the 3115 instructions to make sure you're sending the extra copy to the right place. Please don't forget to send the extra copy to the right place. We see on a semi-regular basis private letter rulings issued because it appears that the accounting firm or other tax preparation firm that prepared the tax return for a taxpayer that was making an automatic method change kind of neglected to make sure the other copy got filed or got the one copy filed with the right IRS office, but failed to attach the copy to the return. So make sure you do both of those things because otherwise it is going to be, while you'll almost certainly get the private letter ruling, private letter rulings do not come for free and they are a bit messy to work through. So yeah, you want to make sure that's fine. This particular revenue procedure applies now. Any 3115 filed on or after June the 9th of this year, is required to do it if it's a year of change that ends on or after October 31st of 24. So basically, unless you're asking for a change of method somehow for an earlier period, I'm not sure at this point that even works, but whatever. We'll get there. Yeah, this is it. So you're going to be using this 3115. Now, what it does, it modifies and clarifies prior guidance. And specifically, it always refers back to Revenue Proc 2015-13. That was the one that started this whole get them all together in one place structure. And then we're just going to update this every few years. So I'll do 21-15-13 and all the following modifications. Now, it does reference a lot of IRC sections because there's a ton of automatic changes out there, right? And a related regulation that governs the accounting method. So it has a lot of things in play. If your client has an accounting method to change, you always want to check here and make sure if there's an automatic method to do it. Because if it's not, we got to get our request started much earlier. But if we're covered by an automatic method, then it's going to be part of just the standard return preparation procedure. Now, what's an accounting method? Simple. An accounting method basically, and we'll get to this in more detail in the case coming up, is some treatment on the tax return that doesn't ultimately reflect the amount of income or deduction recognized, but affects the timing. So, for instance, let's say that you depreciate an asset over, you know, let's say you depreciate it over 39 years, and it really should have been depreciated over 7 years. That changes the timing. So that change from one to the other, and that kind of a structure is what, in essence, costs seg studies. And why you get that big adjustment is because we're making an accounting method change. That change is an accounting method change. And generally, for most but not all methods, you have to pick up the cumulative difference over the years of what your taxable income would have been reported on tax returns through the beginning of the year you changed, had you used the method you're now switching to, versus how much you've reported using old method. If that number is a negative number or below $50,000, then you report it all in 1 year, right? The year of change on the return, just pick it up as what's called a 41-day adjustment. If it affects multiple years, I should say if it's positive, it affects more than 50,000, so we're adding to income, then you spread that over 1 quarter in the year of change and then 1 quarter in each of the 3 following years. That's kind of your structure. Now, the actual things in place, every one of these has called a designated automatic accounting method change number, or a DCN. You will find on 3115, there is a place to input the DCN or DCNs that impact your application. Okay, they're able to allow the IRS to quickly identify and report the accounting method change without having to go through a lot of details and make sure it's the automatic method. Okay, there are some examples of these. DCN 91 are upfront payments for network upgrades received by utilities. DCN number 2 is changes involving advances made by a lawyer on behalf of their client. DC3 is accounting for ISO 9000 costs. And DC4 are restaurant or tavern smallwares package. Okay, these are some of the DCNs, and there are a ton of them. Now, Revenue Proc 2523 introduces several changes to the prior list, which was 2024-23. So apparently we're doing the 23rd Revenue Proc now. That's coincidence, but it was basically a year ago that we had the earlier list. Gone is section 6.22, because late elections under 168J8, 168L3D, and 181A1 are now obsolete. Also removed section 7.013A. It related to SRE expenditure changes for the first year after December 1st, 2021. Those were part of the changes in section 174. Indicates that release no longer necessary. It removes some obsolete references in section 1901 of the ruling, which had references to proposed regulation section 1.4603B1II concerning long-term contract changes. Removed 1902.3A. Again, more, basically research expenditure issues for long-term contracts. That was also removed. In 22.101D, there's an obsolete inventory method provision that is no longer now and has been removed. Some clarifications. It did clarify in describing a 40-day adjustment. It now added for any taxable year in which the election was made to emphasize the specific period an adjustment would be made. For makers, property depreciation changes, section 6.05. It removes section 6.052B, 6.052B, got that, indicating temporary waiver and eligibility rules no longer in effect. For disposition of a building or structural component under section 6.13, it added clarification to it. It also was going to be a similar clarification for a disposition of tangible depreciable assets that were non-building under section 6.14. It has some limitations on when the changes do not apply for interest capitalization in 12.14, talking about if the taxpayer is using the current regulation, section 1.2638-11E1II and 3, or proposed section 1.2638-82D3 and 1.263A-11E and F in the proposed regs. It also removes some obsolete language regarding the overall prior accounting method changes to the cash method in section 1501 of the overall accrual method changes. It added a new provision, 15.08, parenthesis 1B, Roman numeral I, shall we say, to explicitly state that changes from cash to accrual for specific items do not apply to foreign income tax. On section 1512, for farmers changing to the cash method, this was clarified that this automatic procedure only applies to a taxpayer's trade or business of farming. It doesn't allow them to do the same thing for the non-farming businesses unless they qualify for another exception. The reference to section 118, section 15.13, for changes related to non-shareholder contribution to capital. It put changes related to regulated public utilities under Formal 118C have now been converted to a non-automatic change procedure. So that means now you're going to need to get permission. If you have that in there, what used to be there. Uh, Rebates and allowances under 20.07. It added a new section that says this change does not apply to liabilities arising from reward programs. And under section 22.17, we have some inventory change issues that highlights changes from currently deducting inventories to permissible identification and valuation methods. Our key practice issues. You should carefully review this revenue procedure to ensure proper application of these rules. Remember, even if your client's doing something the law does not allow, if it's become a method, generally if a taxpayer does something for 2 or more years consecutively, that's normally deemed to be when they start up the business or the first years they have the issue, that's considered to be adoption of a method. Now remember, even if that method is not allowed by the law, illegal, you can't change it without the service's consent. Always keep that in mind. You want to know what their automatics are. And some of the automatics can fix problems where taxpayers haven't been complying. Others can't. So you have to be aware of that. You need to understand the modifications. You need to make sure, remember, some of these have changed what's covered, what's not covered, the full details of how to do your case. Because what they're going to tell you in each of these generally are things like which part of 3115 you have to fill in. So you need to know that stuff. Again, for the Form 3115, you want to ensure accurate use, the right DCNs, and proper classifications. Really bad to think that your change is automatic when it's not. Because now you've guaranteed that you're going to have to hang on to this method for 1 and potentially more years. Because you don't figure out it was not automatic and you're on extension until October, you're probably way too late to get any change approved for the current year. So now you've got a couple years hanging out there. And one big problem you have the couple years hanging out there is that, especially if it's a method not allowed by the law, if the IRS examines you before you get around to, asking for permission and obtaining permission, yeah, you may have some problems. So it's kind of bad. And also, please remember that, this guidance changes regularly. Don't just file this away and 10 years from now be pulling out and said, hey, on this date, this program said this was the rev proc. I guarantee you, in 10 years, if not in 1 year, this will not be the proper place to look. 2025, 23 is probably going to be about a 1 year, when it's valid ruling. Okay. Now, going from the general idea of accounting methods, let's talk about a specific accounting method change issue with the case of Conmac Investments, Inc. This is Conmac Investments, Inc. versus the commissioner. This was an appeal of a tax court decision to the 8th Circuit Court of Appeals. It's case number 24-1605. The decision came down on June the 6th. Now, like I said, the U.S. Court of Appeals for the 8th Circuit heard this case. And the key issue was, was this thing they did a change of accounting method? And therefore, because if it is, we have strict rules we have to comply with. And that's particularly true regarding amortization and depreciation issues. Get into. Now, the 8th Circuit did affirm the tax court's holding that they disallowed their amortization deductions in the year under exam due to their failure to get IRS approval for an accounting method change. No approval, you can't change. And we'll talk about, in this case, it was kind of a big deal because, yeah, they're going to get deductions down to 0. Their old method didn't deduct this stuff. So now we're going to go with the new method. It is really important to understand, you've got to recognize what happens in all too many cases is people aren't really aware of what an accounting method change is And because of that, they just say, well, it was being done wrong. We're going to just do it right going forward. If it's an accounting method change, you're not allowed to do that. And why might that be a problem? Come on, the law says we have to do it the other way. It's a problem, A, if, like in this case, doing it the right way would have lowered your taxes, potentially. But number two, it's also a problem because even if, the method is going to increase your taxes, the timing of that increase can be a problem because if you come under exam, right, and the service decides that, oh, you didn't have permission, they essentially set you back on the old method and then have you change in the next year. And that can cause some real problems, right? Because when income comes in, when you get income, can in many cases be very important. It's not as big in C corps anymore because of the rates. Although again, if Congress changes the rates, it can be a big deal, right? We do have a flat rate for the most part, but yeah, it can be a major problem. But even for traditional C corps, it can still be a problem. If the year of change, let's say we have carryovers that are expiring coming into the year of change, and therefore having an extra income in that year, we would have offset it with these carryovers. But the carryovers are going to expire now before we can use them. If the change is in a later year, yeah, those sorts of things can really trip you up if you don't recognize you have an accounting method change. Now, this taxpayer was an Arkansas entity involved in farming, Conmac Investments Inc. From 2004 through 2013, it was acquiring farmland. That included rights to what are termed under the law base acres, which entitled the holder U.S. Department of Agriculture subsidy payment. Now, from 2004 to 2008, Conmac did not claim amortization deductions for the base acres. But in 2009, after learning other similarly situated taxpayers allocated acquisition cost to the base acres in which they could then amortize, right? Conmac unilaterally decided to begin amortizing them and just started doing it. That's very tempting. This is messy. We'd have to get IRS permission. We have to say we were doing something maybe wrong, or maybe we're not sure we can get this, so we prefer not to tell the service that we're going to be swapping. So, yeah, they just start doing it going forward. In any event, Conmac, for whatever reason, did not file a Form 3115 and did not obtain IRS permission to change an accounting method. So, if this is an accounting method, this is game, set, match. We're done. Now, the IRS disallowed amortization deductions for the years under exam 2009, 10, 11, and 12. That led to this litigation, right? The years in question. Now, the taxpayer said, wait, it said its 2009 decision to amortize was not a change in accounting method. Therefore, failure to get IRS approval was not a problem. They had a few arguments to it. Their first argument said this was not a proper time adjustment, right? Asserted that it was a recharacterization of allowability. It was not a timing issue. And they cited Regulation 1.446-1E2 IIB and D3 for the proposition that, hey, this was allowability of a deduction. It wasn't really timing. And argument number two said it resulted from a change in the underlying facts. They said, look, if the underlying facts change, then Treasury Regulation 1.446-1E2 IIB says that is not an accounting method change. Finally, they also said the year of change, which under 41A is big, was 2009. So the amortization deductions from 2009 to 2012 should go against income in those years, not all be deducted in 2013. So, and that's what the IRS was doing at the end of this exam, was they were forcing them to wait and make the change in 13, and those deductions, you'll get them, right? We still move them forward under 41A adjustments because they would have previously been deducted. but we're going to get them in 13, not in 2009, 10, 11, and 12. And presumably, we're in court, uh, they were much more beneficial to Conmac if they had been taken in those first 4 years, right? Instead of all coming in 13. Now, the court looked at the underlying law. Again, under 446E, the law is clear. You cannot change your adopted accounting method without the commissioner's permission, even if the IRS changes the law and requires you to change methods. You generally have to get the commissioner's permission. You may remember the 174 research expenditure change. The IRS issued a revenue procedure that effectively just granted everybody the permission who had to make those changes. But we need those, right? However it works, we got to have that. And by the way, the new 174, if the One Big Beautiful Bill Act passes, presumably we're going to need an accounting method change again to go back to expensing them. And then, of course, since under the One Big Beautiful Bill Act, the whole research expenditures also leaves the law again, then we could have another accounting method change. So they're all over the place. They also looked at the regulation, right? The regulations and the law, and noted that an accounting method change is a change to an overall plan or treatment of any material item. And a material item involves the proper time for the inclusion or taking of a deduction, among other things. Again, under Regulation 1.446-1. Amortization is specifically covered in the regs. A change in the treatment of an asset from non-depreciable or non-amortizable to depreciable or amortizable, or vice versa, is a change in the method of accounting. 1.446-1 E2 II D2, that part tells us it's automatic. It just is. And finally, under Section 41 treatment, which is found in Regulation 1.446-1 E2 IID53, a change from non-amortizable to amortizable results in a 481 adjustment. Okay, that's what the court looks at. The court said, look, guys, your action fell dead within the definition of a change in accounting method from non-amortizable to amortizable. That is what you're doing. That's by definition accounting method change. They rejected their proper time theory, right? By amortizing, they changed the timing of cost recovery from disposition to spreading it over years. The cases Conmac cited to try to claim that, well, no, it didn't apply in this case, court rejected those cases. They also rejected the theory that there had been a change in the underlying facts. All Conmac really said was, well, there's been a change in the underlying facts, but never really identified what there were. What it seems they're trying to argue was, we didn't know we could amortize this. We didn't understand this was amortizable. And as the court said, a taxpayer's subjective misunderstanding of fact or law does not equate to a change in underlying facts. The Internal Revenue Code has allowed amortization of intangibles since 1913. This is nothing new. Right? The law didn't change. So that was long before 2009. There was no change that Conmac could point to that impacted magically this type of amortizable cost in 2009, except the fact that that was when they finally found out that, hey, maybe we should be amortizing this. And also, 481 was under Section 41. The court said the year of change was 2013, the year the IRS initiated the change. They pushed it all the way out into 13 because, Conmac had filed 4 returns and had, basically claimed the deduction, but had never received permission. Their unilateral action in 2009 doesn't somehow move it into that year. You have to have the permission. And the other thing to note about it, which is important, is Section 481 allows adjustments for otherwise closed years. And that's probably one of the biggest things about accounting methods. If it's an error, An error would be, let's say, for 1 year only, you accidentally left the amortization off the return. That's an error, right? That is a straight up error. It wasn't your method. You were amortizing for every year before. You amortized every year after. You have an error that year. With an error, once we get past the date when the IRS can, assess taxes based on that, or more importantly, if you left off amortization, you can file a claim for refund. It's basically a done deal. Can't do it. But if you, like this taxpayer, just neglected to amortize it all, so what the court would say is you've actually decided rather than pick up the deduction over the years, you would have picked it up when you sold the farmland as part of basis. If that's what you did, then essentially, right, we've talked about there that if you've done that for 10 years before you found out you had a problem, you're still going to get the amortization for all those years. 41 gets around the quote closed year problem because we're not asking for a refund, or the IRS is not asking to assess tax in a prior year. The 4A adjustment is in the current year, the year of change, and potentially the following three. So we don't have a statute of limitations problem if it's an accounting method change, which is also why that's somewhat important. Is this an accounting method? The key takeaways in this, obviously, as we talked about in the first issue, you got to have permission to make an accounting method change. If you don't do it, you are at the mercy of the IRS. If the change would increase your income, then basically they're going to let it sit there, right? They're probably going to change your method as of the first year. Okay? But flip side of that, if it turns out you're getting deductions, then they're probably going to make you wait. And part of that decision can be made by the service just based on which one's in their interest. Because, it's now theirs. Because it's not allowed, they pretty much can set the date they want, right? You didn't get permission, so they can go in a year and say, aha, you're doing it wrong. Or they can simply say you didn't get permission and force use the old method. Okay? The definitions of accounting method regulations are very strict, right? A material item is related to timing. I've heard CPAs over the years, accountants, CPAs, everybody in this area say, but it's only a timing matter. Accounting methods are timing matters. So it only doesn't solve the problem by using that magic phrase. It's a timing method, but we need to understand that timing method, if we've been doing it consistently, we're going to need the IRS permission to change how we've been doing it. The year of change for 41 adjustment is determined by when the accounting method change is recognized by the IRS, not when the taxpayer unilaterally does it. Okay? And you always have to ensure that you've recognized accounting method changes when they occur on a return, and make sure all your staff understands the concept, and then make sure you've got the proper IRS approval, right? If it's automatic, make sure you put it with the return, right? File a copy with the return, file the copy on the paper copy with the national office. We're done, right? Or with whatever office they're having you file it with these days. Next up is yet another conservation easement case. We have a bunch of these. This is Glade Creek Partners LLC versus Commissioner of Internal Revenue. This is an 11th Circuit case, 11th Circuit Court of Appeals, case number 2314039. Now, again, this is the application of 170E, and in this case, we're going to get into a partnership provision, 724B, when a partner contributes inventory. And also the issue of when you have a contribution of property that would otherwise be ordinary income generating is sold, you don't get fair market value on your contribution. You get only a basis related amount. So the key issue was, were these charitable contribution deductions limited to the adjusted basis of the easement property because it was inventory? So a little different than our previous, valuation cases. The 11th Circuit affirmed the tax court judgment. It limited deduction to the adjusted basis because the property was classified as inventory item in the hands of a contributing partner. That's going to be the key. So, again, this one looks at the charitable contribution deductions involving conservation easements, but tells you we have a problem if we get that property from a partner who is previously going to be developing the property. That's going to be our problem here, is the claims on the returns of the partner that put the property in, what they were planning to do with it. Okay. Now, the donor in this case was Glade Creek Partners, LLC, referred to as Glade, in the rest of this particular part of the presentation. It's a partnership. It gave a conservation easement to the Atlantic Coast Conservancy in 2012. It was about 1,313 acres, originally purchased for a residential development by ILC, which was the partner. Okay, all those issues, right? We're going to do that. Hawk Bluff Investment Group, an S corporation, was formed by the ILC owners to deal with debt. Contributed the easement property to Glade. So we've gone through. ILC was entity first formed to develop the property. However, to deal with some debt issues, they then transferred the property to an S corporation and then contributed that easement property to Glade. Now, Hawks Bluff, right, the S corporation, his 2012 return stated it was a real estate dealer and reported the easement property on the line as inventory. That's going to be a bad, shall we say, labeling. Sometimes you just finish up return and you figure out that, okay, what we call them, what they do, who cares? And, the balance sheet doesn't directly impact. Balance sheet classification doesn't really directly impact the return for that year. It didn't have any deal because they never sold anything. So we called it inventory. That's going to be a problem in this case. Now, the IRS's position, which the tax court went along with, was to disallow the deduction. It had been remanded back to the tax court to decide other issues, right? And a deduction was due, but they disputed the amount. So they conceded the deduction was due. The original case had been that the deduction was disallowed whole. That was reversed, but then sent back down to deal with this issue. How much should it be? Question was the deduction limited to adjusted basis? Because if it's inventory, it's going to only be the basis. If it wasn't inventory, if it's a capital asset, then we get full fair market value. Remember that rule. When you have a non-cash contribution, if a sale of the property would generate ordinary income in the hands of the donor, it's going to be considered to be only basis matters. We don't care. It'll be the lower a basis or fair value will be your deduction. If, however, the property would generate long-term capital gain if sold, then you get a deduction based on fair market value. Right? So this is the one where, yeah, it makes a big difference here, a pretty big difference. Now, first thing that the partnership said, Glade said was, well, 170E and 724B don't apply. 170E limits your deduction to basis if the property is ordinary income property, and 724B says if it was inventory property in the hands of the partner who contributed it, it continues to be inventory property in the hands of the partnership. Now, the partnership said these provisions did not apply. They said conservation easements are exclusively governed by 170H. We know this is general rule, but see, conservation easements are over here on 170H. And they also argued the 724B was irrelevant because Glade still owned the inventory. Right? They hadn't really given the inventory. They'd given an easement on the inventory. And their second argument, okay, even if those sections applied, Glade argued the tax court erred by classifying the easement property as inventory item. They claim that it should have been considered a capital asset. If it was, then fair market value was a way to claim the deduction. Okay, what did the court say? 170E for charitable contributions of property says, reduces the deduction by the amount of gain that would not have been long-term capital gain if the taxpayer had sold the property at its fair market value. So that means that you reduce your deduction by short-term capital gains or ordinary income from a hypothetical sale. Remember, long-term capital gains are generally only generated by sale of an asset, capital asset that's held more than 1 year. And if you sell inventory, you got ordinary income. So, would these easements have generated ordinary income? Section 724B provides that if a property was an inventory item in the hand of a contributing partner, any gain from its disposition by the partnership is ordinary income for a 5-year period from the contribution date. And this did not stay in in Glade for more than 5 years. So that was one of our problems. It was, you know, if it's covered by 724B, excuse me, covered by 724B, then right, we're stuck now. Now, the tax court applied 724B because the easement property was distributed to Glade, a partnership by Hawks Bluff, who was a partner in the partnership. So we had a contribution that would make it work. Okay. So, right, they found it was inventory for Hawks Bluff at contribution. Remember, they put that on their return, right? A hypothetical sale by Glade would have yielded ordinary income under 724B, and that limited their deduction under 170E. Right? That was the tax court's ruling. And, now Glade raised the inability of 170E and 724B for the first time on appeal, saying that, no, only 178H applies. The court said you can't raise that. If you didn't raise it at trial court, you can only raise it if it would either result in a clear miscarriage of justice not to look at it, or if there is if this is a quote significant question. Neither of which did Glade demonstrate this was. They had multiple opportunities to raise challenges in the lower court, but they failed to do so. So what the court said is, we're not deciding whether 170H would somehow magically wipe this off. We're saying, if you wanted to argue that, you should have brought it up at trial court. You didn't. You've given it up. We're not deciding that one. And whether a property is inventory is a question of fact. And the Court of Appeal reviews the tax court's decision on that solely based on clear error. So unless the tax court's decision is clearly erroneous, they're not going to basically allow you the deduction. Now, Glade said it was misapplied, but the tax court applied the Borey versus Commissioner holding the factors have no independent significance. Basically, and non-Winthrop factors, which is another case, can be considered, right? And they said, also we have the reliance on Hawks Bluff's tax return. They said, reliance on what you called on your tax return is appropriate for the tax court. Glade's intent was irrelevant. We don't care what the partnership that got it. Glade clearly intended to make a donation of a conservation easement. That intent wasn't relevant. The intent of what was basically Hawks Bluff, when it acquired the property, and according to its tax return, it was a dealer in real estate, and it was holding that as inventory. That's what's relevant, and the tax court can rely on that. There's no issue there. Okay. What they considered was ILC's purpose, and it found that also was useful to consider, given Hawks Bluff was organized to take over a failing business of the developer with shared ownership. And Glade didn't introduce any credible evidence that would have shifted the burden to the IRS under 7421, so that Glade had to show it was not inventory. And they simply didn't do that. What's key implications here? First thing is, remember 724B. If a partner brings, especially in real estate, if a partner was a developer, right, and they take that inventory and they're going to contribute it to your partnership, remember it's going to carry that inventory tape for 5 years. So you have to remember any sale during the 5 years will be ordinary income. And if you try to give it away as appreciated property, you're also going to find it's ordinary income, going to be limited in this case. Again, in this case, as we noted, characterizations inventory essentially killed the charitable deduction under 170E. Now, remember, the Eighth Circuit did not really look at whether or not 170H might have overwritten this, saying you brought that up too late. Forget it. You got to look at the contributing partner's intent and past activity to determine the inventory rule of 724B comes into play. Again, we don't care what the new partnership's doing. It is the partner, not the partnership, who we have to look at for this call. And also remember, this is more for those in the legal profession. You got to make sure that all proper issues are raised in lower court. We're going to discover later where you, as a CPA or EA preparing a return or a claim for refund, where you might fail to raise an issue, and then that screws up the case later. But that's a different problem. We'll talk about that later here, right? And remember the tax returns, those supposedly little things. Who cares? We call it inventory. We cared in this case, right? That was considered a key admission, right? You admitted it was inventory, and suddenly that's a problem under 724B. Next up, Kramarenko versus Commissioner. We'll look at the tax treaty exemptions and treatments of payments in a postdoctoral position. This case is Tax Court Memorandum Decision 2025-61. The decision came down on June the 9th. Now, we're looking at the interpretation and application of tax treaty provisions related to exemptions for students, trainees, and researchers. This was under the U.S.-Russia Tax Treaty, Article 18. And the key question that the court had to decide at the end, that it found was a key question, was whether payment to a postdoctoral researcher constituted tax-exempt grants to the researcher, or were they taxable compensation for services? And the tax court held that Dr. Kramarenko's compensation was not exempt. It was compensation for her services due to a substantial quid pro quo arrangement with the college, with, in this case, a medical school in South Carolina. Now, the relevance of the case, and this, by the way, applies not just if you have somebody from Russia or wherever. It's not just a treaty issue. As you'll discover, they look at the underlying law under 117. So there is a difference between taxable compensation and tax-exempt grants. And one of the key tests you apply in this area to get you, just before we even start looking at whether otherwise you can meet the qualification to exempt it, is whether or not there is a quid pro quo. And by that we mean, was this clearly a payment by the university for services that they needed performed, regardless of whether you did it or not? So you got your education and experience in this area, and the university got the research done that if you had been there, they didn't have a postdoctoral candidate, a postdoctoral person to put in, researcher, they could go higher. Presumably, probably needed one of those for this, but still, assuming we didn't. Uh, if that would have been hired anyway, it doesn't matter. Right? It's not your research. It wasn't just pure research. So the taxpayer in this case is Dr. Inga I. Kramarenko. She had a PhD in biophysics. She was a full-time postdoctoral researcher at Medical University of South Carolina, MUSC. Now, she performed laboratory work, received training, and was compensated with a salary and employee benefits. Now, her position was funded by National Institution of Health Research Project grants, R01 grants, received by principal investigators in the university, not directly by Dr. Kramarenko. Also interesting here. Now, the university consistently reported this as salary on assignment information sheet. Now, Dr. Kramarenko filed 1040 NREZ for 2010-2011, reporting the salary as tax exempt under Article 18 of the U.S.-Russia Tax Treaty. She made certain misrepresentations, mistakes, whatever, regarding her filing status, a single non-resident alien versus a married resident alien, and her tax home. Was it really Russia or the United States? Now, her claim was that her salary constituted a grant under Article 18 of the U.S. Russia tax treaty, thus exempt. Such activities could be securing trading under 18.1b of the treaty or doing research under 18.1c. Now, the court's general principle, as a resident alien, Dr. Kramarenko, get her name right, I probably butchered it there, was generally subject to U.S. income tax. Compensation for services is considered gross income. So they interpreted it, right? Article 14, salaries and wages of the treaty generally permits the host country, the U.S. in this case, to tax salary, wages, and other similar remuneration received in respect of employment. Article 18, for students, trainees, and researchers, exempts grants, allowances, or other similar payments for studying, training, or research purposes. Now, the court noted for Article 18 to apply and exempt this, these payments must constitute a grant, allowance, or other similar payments, regardless of the activity she's doing. And they say these two provisions are mutually exclusive. Salaries and wages under Article 14 are distinct from tax-exempt grants under Article 18, citing doctrine and commission versus commission. A grant paid as a salary is, per that case, an oxymoron. Now, this treaty interpretation relies on U.S. tax law and specifically the application of Section 117 for scholarship and fellowship grants and Treasury Regulations 1.117-4. And in those hold that amounts representing compensation for services are not considered scholarship or fellowship grants. In Bingler versus Johnson, a U.S. Supreme Court case on this issue, scholarships and fellowships are relatively disinterested, no strings attached, educational grants with no requirement of any substantial quid pro quo from the recipients. Any payment for which the grantor unquestionably extracted a quid pro quo, that is, they got something of value, are taxable compensation. You do work for me, I give you the training, I allow you, to get this experience and, see this research under. Now, to assess quid pro quo, Botrin assigns 5 basic tests. If not the taxpayer, would the university have brought someone else to work on the project? This kind of aims of, was it really her research, or was it the university's research? Did the projects she worked on, pre and post date her tenure, or were they dependent on her being there? Again, we're kind of looking at the same issue. If these projects were going on before she got there and or continued after she got there, that doesn't look like her research. That looks like the university's research that she is merely an employee working in. Did the university, retain the rights to the product of her research? Because if they did, that also looks like a quid pro quo. They're getting this valuable information from her research and they're keeping it. They have the right to use it. She's not the one that owns that, right to make use of that, whatever rights may be generated. How much discretion did she have to direct her day-to-day performance of her work, or was she essentially working under the supervision and orders of someone else with the university? And that ultimately comes down to, does any of this represent a substantial quid pro quo? In this case, essentially, the court's going to find that she basically failed all these factors. Right? None of them were good for her. First thing the court said is we don't care how the thing was labeled. The salary label is not determinative. And the fact that this money came from the National Institutes of Health grant to the university did not transform these payments to grants either. We're looking at what they really were, not their label, and not the fact they came from a National Institute of Health grant to the university, not to her. All of the Batrin factors, as I mentioned, favored Trina's compensation. The university would have hired someone else if she had been unavailable. Graduate students had previously filled this position. So, they would have just found somebody to fill it. The research project predated her tenure. The grant from the NIH would have continued if she left. It looks like the university's thing, not hers. The university, not Dr. Kramarenko, retained patent rights. Her contributions furthered the university's mission. Generally modest discretion. Work was consistently at the principal investigator's direction and within the confines of the grant. And she provided substantial quid pro quo. She provided her techniques and expertise, her skilled labor, and the university provided mentor training experience and salary. Her research directly benefited the university. That was compensated service. Therefore, the payments were compensation for valuable research services, primarily for the university's benefit, their salary. Now we get to, okay, she's lost on the tax issue, but, you know, is Dr. Kramarenko, is she really liable for penalties? I mean, yes, she has a PhD in biophysics, but, doesn't mean she really understands the tax rules, right? Okay, well, we'll get to this. The IRS met the burden for showing there was substantial understatement. $5,000 threshold. Remember, if there is a substantial understatement of tax, you owe the penalty unless you can show reasonable cause and good faith under 6664C1. Generally, reasonable cause and good faith is going to require you to have done what a reasonable person, with your knowledge and background, would have done to ensure the proper reporting of these items on your tax return. And while she did have a PhD that was not not a PhD, she wasn't an attorney, right? A tax attorney. She didn't have a PhD, she didn't have some sort of doctorate in accounting with a tax emphasis. But she had a doctorate, which generally is going to argue against you, meaning that you understand the importance of trained expertise and you should have figured out you didn't have it, right, in that area. It was not your area. A PhD what was it, biophysics was her background. A PhD there is not training for dealing with taxes. You probably should have taken additional steps. As well, she disregarded the W-2s university sent to her, right? The university had indicated this was taxable compensation. She relied on her self-interpretation and asking colleagues who clearly weren't tax experts, never consulted a tax professional, right? She never consulted. So again, they may be PhDs, in biology, etc., but doesn't mean they're tax experts. Her misrepresentation on the return, filing status in her tax home, and her admission of uncertainty undermined her defense by saying, look, you even kind of knew you didn't know what you were doing. And you kind of knew the people you're talking to weren't really tax experts. So it seemed like a reasonable PhD in whatever topic would have probably sought out an expert in the area to get advice on how to properly report this. The bottom line, treaty exemptions are narrow. And in this case, remember, under 117 as well, genuine grants and compensation was critical in this case, which was which. If you have this case of, is this payment under 117 a grant, which, by the way, then there's still other steps you'll walk through after that. But remember, if it's compensation, cannot be excludable regardless. Basically, we're done there. Uh, we're going to have this quid pro quo to see whether we actually have a grant. And then we'll conduct the other items to look at this. The substance over form, labeling doesn't really matter. In fact, the funding was a grant to the university. You don't that doesn't filter down to everybody that works on the project. The grant's university's grant, not everybody's grant, right? Certainly wasn't tied to her. And also, if you're going out of penalties, taxpayers have to show, to get reasonable cause and good faith, that they made a reasonable attempt, given their knowledge and background, to properly determine their tax liability. And sometimes you have problems like, I mean, I know the court's theory was a PhD should have known this, but you sometimes have a problem that people that are very intelligent in one area, have great expertise in one area, have trouble admitting that maybe they don't have expertise in every other area. And in this case, obviously, the court held that, yeah, you got this totally wrong, right? That's it. And remember, reasonable cause and good faith is that you may have gotten it wrong, but you did as much as somebody in your position reasonably would have been expected to do, right? Okay, now we're going to go to how you can foul up a 1040X and cause problems in the future. This is Shleifer versus United States, Scotch and Elena Shleifer versus United States from the United States District Court, the Southern District of Florida, case number 9:24 CV 80713, and it was issued on June the 10th of 2025. It's when the opinion came. Okay. Now, this looked at strict requirements to substantiate deductions and the critical role of the variance doctrine. And the variance doctrine is going to be the key thing here in tax refund litigation. The question was they disallowed an appreciation deductions claimed on Schedule C. And then when the taxpayer said, well, it would have been allowed on Schedule E, the court said you didn't raise that issue at the proper time on your administrative claim. And so because it was never fully raised and documented, you know, we have no right to consider it at this point. You had to raise it and give the IRS the right to act on that issue. And they said what you did didn't really go to the level of formally raising the issue. We'll find out that they made a statement that said, well, well, maybe it should have been on Schedule E. And the agent said, okay, maybe that would have worked. But that's not what you did. And the taxpayer never, during the administrative portion of this, didn't ever go forward and provide documentation that would have backed up the Schedule E issue. Okay. The court granted summary judgment to the IRS, disallowed the refund claim. The Schedule C wasn't a proper place to deduct this aircraft depreciation because there was no profit motive, there was no business actually inside the Schedule C. It had no way it could have made money. And the Schedule E argument was barred by variance, right? You never suggested in your formal, administrative proceeding, you never actually presented the evidence to show why Schedule E would have been an appropriate place to claim it. Really have to accurately and comprehensively assert all grounds for any refund claim you might. In this case, not pushing that cost the taxpayer the right to argue for it. So the taxpayers were Scott and Lena Shleifer. They were seeking only a $1.9 million refund for 2014. Now, SLS Travel LLC was solely owned by Mr. Shleifer. Think remember LLC, and it held a 37.5% interest in a private jet. Now, key fact was that SLS was not operating to provide a profit. He used the jet to travel for business, but he bore the cost personally despite firm reimbursement for commercial travel. So this is going to be the key, right? It was personal. He did it. Originally, the 2014 Schedule E claimed $2.6 million in travel deductions as unreimbursed partnership expenses. On an amended return filed in October 2018, he sought a refund for inadvertently neglected depreciation on the private jet that had not been claimed on the original 2014 return. That's $5.9 million of depreciation, right? Reported no gross profits for SLS. It didn't really do anything, right? The actual doing something was essentially the partnership or S corp. I forget which one it was right away, but it was over there. It was on Schedule E, that entity, right? I think it would have been a partnership to get the way he's trying to get it. Now, the IRS requested documentation and ultimately disallowed the Schedule C deduction. Now, post disallowance, or by oral arguments, his accountant says he said his account orally advised IRS agent depreciation should have been on Schedule E as an unreimbursed partnership expense. No written request or documentation is submitted to back this up. We basically have, the accountant's testimony that he raised the issue with an agent, right? Okay. So that's where we're going with that one, right? As we go. Now, they argued that they should be awarded the refund because depreciation, though on Schedule E, met all the requirements unreimbursed partnership expense on Schedule E. The IRS said the plaintiffs are not entitled to anything on Schedule C, right? Nor do they get the Schedule E deduction, because even if that's valid, which the agent had supposedly told the accountant that it might be, the variance doctrine precluded because they didn't push forward with that theory. Now, for tax refund suit, the taxpayer bears the burden of proof to establish the IRS made the wrong call, and the court noted, which is something they will, that deductions are a matter of legislative grace. Taxpayers must strictly comply with the requirements to claim them. Now, to be on Schedule C, it must be appropriate for reporting trade or business income or expenses related to a trade or business. There is no question that you could report depreciation under 167A1 for property used in a trade or business on Schedule C. But to be able to call it a trade or business, the primary purpose for engaging activity must be for income or profit. And the court found that the taxpayers admitted SLS was not operated to generate a profit, had no gross receipts, paid no wages, offered no travel service to the public, and had no operating costs or depreciation. It was a place to claim depreciation only. Right? There was no profit motive. There never could be in this design. Somehow, no revenue ever is not really ever going to generate a profit. We'll put it that way. Therefore, the Schedule C was gone. No question, couldn't change that. Now, the variance doctrine. And this is where the accountant apparently fouled up. Okay. The variance doctrine holds that you cannot raise a refund claim effectively first time in front of the district court. Remember, one of our rules is you have to file a claim for refund with the IRS first, let them act on it, or wait 6 months. And if they either deny you the claim, or at any time, you don't have to wait 6 months if they deny it, or if they rather, just don't act in 6 months, you can then sue and go to court. But you can only go to court on those issues that you provided the IRS an opportunity to consider and dispose of. Right? The idea is the IRS should be able to, know everything that you're going to try to claim before it decides whether to litigate or not. The requirement is found in Section 7422A in Treasury Regulation 301.6402-2B1. A refund claim must set forth in detail each ground and facts sufficient to appraise the commissioner of the exact basis thereof. Subsequent litigation is limited to grounds that were part of the refund claim, right? A court cannot consider grounds that are impermissibly vary or augment those grounds that were present in the refund claim. You can't surprise the IRS in court. You had to have given them everything. So, they could have avoided the cost going to court because they said, hey, we looked at this and wow, you know what? Schedule E is where it's perfectly good there, period. We're going to let that go through. And one of the problems, let's go. The court amended return limited the claim to Schedule C depreciation. No, everybody agrees there was nothing on there about claiming on Schedule E. There was no proposal to deduct the amount on Schedule E, even though they included, in a extra, in the as amended copy of return they sent along. The Schedule E's in there for other expenses. It was there. It had other, unreimbursed partnership expenses. The accountant's oral advice that it should have been on Schedule E after his allowance was not enough. Oral claims are generally not valid. Now, the accountant said, or the taxpayer said, that the accountant told him the agent said that while it might be possible on Schedule E, he was going to disallow it anyway. Theoretically possible. So, they made the decision not to go ahead and press for a Schedule E decision. That was a decision that may have come back to haunt them. What the court pointed out was, remember, to claim unreimbursed partner's expense, there is a requirement that you show it was either the policy of the partnership that you were expected to incur such expenses and the partnership was not going to reimburse those expenses, right? Either that's their policy or that was specifically part of your partnership agreement, right? In there for sure. And then you also still have to carry all the burdens you'd have to carry to document that, you were a right to claim the deduction. So because we travel, obviously the higher standards under 274 would have come into play. So we have all of this issue. The plaintiff's arguments that, wait, this is the same asset, same year, same calculation. The overpayment would not have changed by a dime had it been moved off Schedule C and just allowed as unreimbursed partner expenses on Schedule E. The court said that's not enough. The IRS is not required, in the words of the court, to act as a detective, to figure out every possible way you might be able to claim this deduction. You failed to formally raise the claim. Should have raised this matter in writing, at the very least, with the agent when they were going through, after they had initially rejected your claim, when you were going, after they originally said they were going to reject the claim, you should have at least raised this as a revision to your claim. Didn't do that. You didn't say, hey, well, it should be this way. You didn't preserve your right to raise this question. The key omission was essential elements for an unreimbursed partnership expense were not alleged or substantiated at any point during the administrative process. You didn't show what the policy was. You didn't show the partnership agreement required you to do that. You didn't show, basically, all the things the partnership needed to show, to kind of make sure this was a partnership expense. We're taking it there. It was valid. You didn't present that to the IRS. As I said, they made the decision to litigate without having any of that information because you wouldn't provide it to them or didn't provide it. You should have. You did. Tough luck. Didn't preserve that right. Key issue here. Remember, the problem here, let's assume for the moment that it would have been allowed as partner expense because the court said we didn't have to decide that. The reason we never got there was because of what was done with the 1040X. What was done with the exam generated by the 1040X, where it was never formally proposed that the deduction should have been treated as a Schedule E partner expense, as a alternative to allowing it on Schedule C. It's important to state the exact basis and potential alternative basis of your claim. In in that 1040X, they failed to do so. You want it detailed in writing to the service. Oral communications are generally not going to be sufficient. Need it to be in writing. So I don't care that you believe, and I understand their theory. What's the point? The agent's going to disallow it. We're going to spend this time writing this up. It'll be disallowed. Why should we waste that time? The answer is because you want to be able to argue this in front of the judge. You're going to present the case in a refund claim to the IRS, even if you know they're going to turn it down. Because you want to show they had that data in front of them, and they still went ahead and said, nope, we're disallowing. Again, the IRS is not obligated to infer other ways you might be able to claim this deduction. You're required to put all the theories forward. The IRS is not required, and the evidence to back those theories. The IRS is not required to try to figure out all the ways you might do it as part of their deal. Also, remember, and I've seen people try this before, Schedule C is not where to put this sort of stuff. Don't have a plane with depreciation on Schedule C by itself. Right? It needs to get related to the trade of business it relates to. Right? Don't forget, as we said, the compliance doctrine. It's costly and harsh outcome. If we assume it would have worked as a partner expense, had been claimed there before, and apparently there had been exams, or if there had been exams that had been cleared, irrelevant. You failed to do it this time. And remember, thoroughly analyze and document all potential grounds for deduction before you file your claim for refund and before you initiate administrative review. Get every theory on the table. You see that quite a bit in court decisions, right? We've discussed some today where, even we're talking about the accounting method, they had a couple of theories, right? They had 3 different arguments as to why they should be able to preserve it. Now, true, they lost them all, but all the theories were there. You want to make sure you present all the theories when necessary. Let's talk about the U.S. Supreme Court. This is a case we discussed oral arguments on a few weeks ago. Now the decision is out for Commissioner versus Zuch. This for U.S. Supreme Court, decided on June 12th, case number 24-416. If you don't remember this case, we discussed it. This was the jurisdictional limits of the U.S. Tax Court concerning appeals from collection due process hearings where the taxpayer was raising the claim because the IRS had proposed to basically file a lien, and they were disputing the lien. The key issue, which the tax court and the Third Circuit disagreed on, was whether the tax court retains jurisdiction in that appeal once the IRS has rendered the levy moot by having collected the entire balance they were going after with the levy via, in this case, applying refunds the taxpayer received on later returns. Did that moot it? The tax court said yes, because our only jurisdiction here is to decide whether they can do a levy, and they can't do a levy. There's no balance left due. So game over. You won. Where she's saying, but I was fighting over the whole question about they should have applied these estimates. They should have applied these payments, and I never should have had any balance due. And so therefore they were leaning, and they should have been leaning. It was paid for. And the court said, well, the problem is the section we're looking at here just says, you're challenging a lien. There will not be a lien, so you won. Or more appropriately, there is no relief we can grant. This is not the right place. You're now in claim for refund territory. And, you need to file either in the Court of Federal Claims or you need to file in the U.S. District Court. Which, by the way, she did. That's later. The Supreme Court does note that. Now, the Third Circuit said, no. Once you initiate this position, and you're initiating it, and the question is, there really should have been no balance. There was nothing to levy. If the taxpayer then takes funds otherwise from the taxpayer and gets rid of the balance that you're trying to levy, it should be able, the taxpayer should be able to continue this. And if the IRS, if the tax court determines that, yes, there should have been estimates applied against her liability, and therefore, there was nothing for you to lien when we started this, that they should be able to order the IRS to give her the money back. Okay? The Supreme Court disagreed with the Third Circuit. It found the tax court lacks jurisdiction under Section 6330 to resolve disputes once there's no longer anything to levy. The fact that the reason that the taxpayer was claiming there was nothing to levy to start with, and the reason was because they hadn't applied payments against the account, was irrelevant when, under either theory of the case, there was no levy, and this was entirely about where they could levy. So this does impact how taxpayers and professionals navigate IRS collection activities, particularly when a levy threat ends up being withdrawn because the balance was paid off. So Jennifer, they remember her. She disputed the IRS application, $50,000 estimated tax payment. It was applied to her ex-husband's account instead of hers. This goes back to late filed returns, all kind of mess. You can go back to the original discussion, and it has all that detail. Now, the IRS sought to collect Zuch's alleged underpaid taxes by proposing a levy on property she owned. He requested a CDP hearing, collection due process hearing, to contest the proposed levy, arguing that the payment was misapplied. The appeals officer rejected her argument and issued a notice of termination sustaining the levy. That notice of termination sustaining the levy was the taxpayer's ticket to the tax court, and she filed to the tax court under Section 6330D1, challenging that determination that sustained the levy. Now, during the tax court controversy, while we're still before the court, she filed tax returns that had overpayments on them. And the IRS, as they are wont to do in cases like this, simply applied them to that 2010 liability that was outstanding, eventually reducing it to zero. At that point, the IRS moved to dismiss the tax court case and said it's moot. There's no basis for a levy. We're not trying to levy anymore. We couldn't levy. So the question about whether the levy action was valid or not is irrelevant at this point. Yeah, there won't be a levy. Now, the tax court agreed. They said, yeah, under 6330, the tax court does not have freestanding jurisdiction to determine overpayment or to order a refund or credit of tax paid in these proceedings. There are other laws worded differently where they would have some rights, but not in this. This one solely gives them the right to determine if a levy action was valid. And that's become a non-issue. There will never be a levy filed. So, they're saying all we could say is they can't file a levy, and well, doesn't really matter, right? The levy's gone. Now, the Third Circuit vacated, but acknowledged that the Fourth and the District of Columbia circuits had both ruled just the opposite. Like the tax court, they said this is only related to levies. Now, her goal was to continue tax court appeal to litigate the misapplication of her payment. She thought a favorable ruling would essentially require a refund. The Supreme Court, in an 8-1 decision, authored by Justice Sotomayor, held that the tax court is a court of limited jurisdiction. It possesses only express powers conferred by Congress. In this case, 6330D1 was the levy determination proper, is the sole basis of the case and the sole basis for jurisdiction. Now, the court, in the decision, defined termination under 6330D1. The IRS said termination refers exclusively to the binary decision of whether or not a levy may proceed. Zuch said termination encompassed the appeals officer's resolution of all items raised in that determination, including liability. The Supreme Court agreed with the IRS. Determination in 6330D1 refers to the binary decision, yes or no, can the levy proceed? We know the answer now is no. It never will happen. Bingo. Issues decided. The matter is moot. Zuch's dispute about the payment was an input to the termination, but not the termination itself. And according to 8 members of the Supreme Court, basically, she has no right to go forward. Now, 6330 is fundamentally about contesting a protested levy, which, if you check it, it is. Default rule is pay first and seek a refund. If you're owed money, if you think the IRS owes you money back, under 7421A, generally you have to pay first and seek a refund. 6330 is a narrow exception triggered by a proposed levy. That levy has to still be in question for jurisdiction to stay with the tax court there. The tax court's authority under 6330E is to enjoin a levy or proceeding only in respect of the unpaid tax or proposed levy to which termination being appealed relates. The opinion states there's no authorization in there to order refunds or issue declaratory judgment to resolve tax liability disputes. The power to enjoin a levy depends on the levy's existence. Without a levy, the authority of the tax court goes away. There will never be a levy, period. There is, therefore, the matter before the tax court was decided. So what the court said, the appeals officer's determination was whether the proposed levy could proceed. That's her determination. The tax court initially had the jurisdiction to review that determination and assess predicate conditions, the allocations of payment. But when her 2010 liability was reduced to zero because she overpaid taxes on later returns, there was no longer any basis for a levy. As I said, it mooted the matter. There was no remaining determination for the tax court to review, and her appeal became a request for an opinion on tax liability independent of collection efforts. And the tax court correctly dismissed this. That's not their thing. It's now a refund claim. Now, Justice Gorsuch, and by the way, they point out he has actually filed, a case in the Court of Federal Claims to attempt to get the money back. Now, there was one dissent. It was Justice Gorsuch, and he argued she still had a live claim concerning the crediting error, which could impact later overpayments, which it did in this case. He said the jurisdiction was once the termination was issued, not whether there was a continuing levy. Now, do realize there are 8 justices that says, no, Justice Gorsuch, you're wrong about this. Yeah. Gorsuch is willing to go, I think, in many cases. We've seen a few cases where I think he is willing to go somewhat outside of what might be a more literalist interpretation that other justices tend to make. So I think it's not totally out of character for him to go down this path. But I also don't think he's ever. I think you got to get rid of at least 4 other justices and have 4 more that think like him before this would ever change. He's worried the decision provides the IRS a roadmap for evading tax court review by dropping levies to avoid unfavorable rulings on an underlying liability. Well, yeah, but you want to get paid, there needs to be a payment structure. Obviously, an obvious thing that you would think of at this point is, well, if Jennifer had just assured that she'd have excess tax withheld, right, or paid in, then there would have been overpayment and, it wouldn't have disappeared. You got to be a little careful about that too. Now, the issue for us, this makes it very clear the proposed levy is the core jurisdictional element for tax court review in these cases under 6330. The only question is, can the levy go forward? If the IRS eliminates the need for a levy, it's offset the entire tax court will likely lose jurisdiction because, the underlying tax liability disputes or overpayment claims, don't worry about those anymore because if there is no levy, that's all they were deciding. And the CDP hearings offer a narrow prepayment review when a levy is threatened and no prior opportunity existed. This avenue dies once the collection threat's removed, the levy's removed. For a threat, they got it. As noted, following these disputes, after a levy threat is withdrawn, the taxpayer has to move to a suit in district court or court of claims. It's the only recourse in this case. And you got to advise clients to consider the potential need for separate administrative refund claims in these cases and Apple statute of limitations to make sure the statute's open. You have filed a refund claim and asked for your money back, right? So in case somehow this gets paid off, we still have the right to take the refund claim to court. Finally, IRS issued Notice 2025-33 on June 12th. This mainly impacts the 1099 DAs coming up for digital asset reporting and mainly compliance issues for the brokers in this case. This was issued, as I said, June the 12th, Notice 2025-33. This provides extended transitional relief for digital asset brokers regarding information reporting and backup withholding obligations. It impacts compliance under 6045 for information reporting and 3406 for backup withholding and related penalty provisions. It acknowledges brokers are building complex systems, is what it did in this writing, and need additional time to implement backup withholding systems, obtain certified taxpayer identification numbers, and classify foreign persons. Therefore, this applies to digital asset sales affected on or after January 1st, 25, because we are going to get 1099 DAs end of this year. They're not required to provide basis information, though they can if they want. They are required to provide sales information and explicitly modifies prior guidance that given relief that didn't go into this year in Notice 2024-56. Now, under 6045A, the new basis reporting rules, brokers have to file returns with the IRS, including the customer name, address, gross proceeds, and other information. Final regulation requires an IDA and pay statements for digital asset sales on or after January 1st, 2025 of gross proceeds. Adjusted basis reporting comes 1 year later. Now, no information return is required for sales for an exempt foreign person, provided that the broker has valid documentation, a Form W-8-BEN, to show that they are an exempt foreign person. If the broker does not comply, they face penalties under 6721 for failure to file information returns, it's an NDA, 6722 for failure to give the payee the return that they filed to the IRS, which they missed both. There is no penalty relief if the failure, though, is due to reasonable cause and not willful neglect. The IRS is going to kind of give you a blanket penalty relief for some of these issues. Let's talk about what they are. Now, under 3406A1, there's mandated backup withholding if the payers, the brokers, have to withhold 24% if the payee refuses to provide ITIN, or if the IRS notifies them of basically an incorrect ITIN. You know, payments on information returns required to be filed by brokers under 6045 are reportable payments for backup withholding. Again, non-exempt foreign payees must furnish a certified TIN on Form W-9. And under 3403, the broker is personally liable, right? The entity itself is liable for any unpaid backup withholding tax, right? If they don't do it, they have to pay it themselves and then probably have a tough time getting it back from their customers. There's additional civil penalties under 6651 for failure to pay. Failure to deposit may apply under 6656 unless due to reasonable cause. And the IRS does provide programs to verify name and TIN combinations. The participation is optional, and it does not trigger backup withholding notices if a taxpayer doesn't pass. Would be an idea, though, that there's a good chance you're probably going to get that notice. The IRS. Okay, so the broker would kind of know that. Now, generally, this notice provides relief for information reporting under 6045 and temporary relief from backup withholding for digital asset sales for the rest of 25. For calendar year 25, backup withholding is not required on the digital asset sales in this period. Don't need to do backup withholding. For pre-existing customers, the alternative TIN procedures for sales before January 1st of 27, the brokers can use alternative positions to obtain TINs from accounts open before January 1st, 2026 by matching with the IRS TIN matching program. So the idea is they can use alternative provisions if they're not given the TIN, but they can match the TIN. They can use that program. They can use that method for sales before the beginning of next year. Or before, I should say, on that issue. And that's all the way through, say, 2027. Digital asset for digital asset sales. For sales before January 1st of 27, the backup withholding will be limited to 24% of the amount received from the immediate liquidation of the received digital assets. There's going to be penalty relief if the value decreases. They recognize that digital assets can be wildly volatile. So in a very short time period from the time that let's say the sale was executed, or the transition from, let's say, Bitcoin to some other, cryptocurrency took place until we actually are able to get it and sell off, get a sale transaction through. The price could change radically. So we might not have, it could conceivably drop so far that we don't have 24%. Right? Even if we sold everything, we'd have 24%. What they're saying is the broker just say, hey, I'm going to just sell 24% of the Ethereum. Right? Whatever Ethereum they got, we sell 24% of that. And that's going to be our maximum amount we'd have to basically, pay in. Be 24% of the value of the Ethereum. Exempt foreign persons and pre-existing customers for sales before January 1st, 27th. Allow the treatment of pre-existing customers as exempt if not previously classified as U.S. persons and with non-U.S. resident address in the broker's files. Right? If the only address they've got is U.S., why? The backup withholding relief is extended, not required for any digital asset sales during calendar year 25, and now we're going to kick that to 26, additional year relief. And the alternative TIN collection procedure 2027 sales. Brokers can rely on uncertified TINs of pre-existing customers for sales in 27 if they use the TIN matching program and receive a match prior to the transaction taking place. Not going to let you do this at year end. Going to have it before the transaction took place. Also, relief for treating pre-existing customers exempt foreign persons for 2027 sales. For sales in 27, none of the 6721, 6722 failure to file the 1099 DA or failure to provide it to your customers will apply if a customer account was opened before January 1st, 2026, not previously classified as a U.S. person, and there's a non-U.S. residence address. Backup withholding is also not required for these customers in 27. And again, for sales account year 27, backup withholding is limited to the amount received upon immediate liquidation of 24% of the received digital assets. That includes penalty relief for any decrease in value between the transaction and the liquidation. So this gives brokers about a year's more time in general on all these to build and implement complex systems for information reporting and backup withholding. The key deadlines, okay. For 2025 and 2026, no backup withholdings will be required. And for 2027, you have the alternative TIN reliance and specified foreign person treatment allowed, providing the conditions met. So if you represent one of these, one of your clients is this, or you actually work for one of these, yeah, you got a bit more of a break now. Now, for due diligence, for the practice issues, ensure any of your clients that are subject to these rules understand and comply with these conditions for transitional relief. Remember, it's not blanket. For a lot of this, you've got to meet specific conditions. Make sure your clients document they met those conditions. Advise clients to leverage those extended periods to do their system development, data collection. And because this is changing, keep an eye. We may have additional guidance. IRS may give additional relief. We don't know. Keep your eyes on this and see how things are going forward. This has been the current federal tax developments for June the 16th, 2025. As always, this is brought to you by your State Society of CPAs. You can email me if you have quick questions, edzollers at currentfederaltaxdevelopments.com. I also do pay attention to posts on the Connect sites for the Arizona Society, Idaho Society, New Jersey Society, Minnesota Society, Illinois Society, Washington Society. Get all those in there. So if you remember one of those, you can go ahead and post there. And if I see your message and think I can help, I may respond there. Otherwise, we're going to see you guys back here next week. Remember, June 16th is the estimate day. So, right, the 15th was Sunday. You got the one extra day. So make sure you get that done. If you have any June 15th due dates out there, which sure there are, right? I guess February 15th C corporations, right? Would that be, yep, we'd get those. That'd be June 15th. February 15th fiscal year individuals. And we don't usually, I've had one of those my entire career, fiscal year taxpayer, March 31st. Died many, many years ago. So yeah, don't have any now. And if you ever had one of those, you probably are figuring that one's more than enough for your time. So we did that. Actually, when the husband died, it was the wife immediately swapped over to calendar year. I think it drove everybody crazy except the husband was the one that really liked that fiscal year. I thought it was funny. But yeah, we're changing that. Loved him, but yeah, we're changing that. We're gonna go calendar. We're gonna go calendar to make this work. Oh boy. Recovering a little bit from a cold I caught on my trip back to New Jersey that I told you about last week. I came back for a little fun. So we did that. So otherwise, again, we'll see you next week here on Current Federal Tax Development.